So welcome everybody. Today is October 30th. It's 6:06 Central Time, 7:06 Eastern Time. Very super happy, excited to bring the best of the best to you guys. Stay tuned. We're planning to do other educational webinars specific to commercial real estate, what's happening in the self-storage industry here in Texas. I have a beautiful, very smart colleague here, the one and only Anya. She was graciously enough to share her evening with us, putting away time from her family. So we're gonna do a very nice work on going over the slides and holding the questions until the end. Unless you want to use the chat and you're not able, don't turn on your camera if you're driving, so be safe. So the idea is to keep the questions until the end and make it very interactive. And this is happening as we speak. Hot from the press changes that totally are going to benefit from every single one of you investing in real estate. So let's get started. Today we're going to talk about how to cut your 2025 tax liability in half without doing any work. So before we get started, I'm going to present Anya. She's very experienced on the bonus depreciation and some of the other numbers that people have some allergies. But once you see those numbers in the bank account, she's going to be your best friend. So take it away, Anya, and just introduce yourself and tell us a little bit more what you are here today and what you like to do on a regular basis with real estate investors.
Thank you, Alberto. Thank you for having me. As Alberto mentioned, my name is Anya Smelek. Title at my job right now is Cost Segregation Specialist. I work for a company called RE Cost Seg. But I've actually been in the cost seg space for a little bit over 4 years. And once you understand what cost seg is, it's actually a really exciting tool that the IRS has given people who own real estate. So I work with, property owners, CPAs, investors, and really we're just trying to maximize tax savings through the strategic asset reclassification of cost segregation. So for no further introduction, we can just move on to the next slide and we can start explaining what cost seg actually is.
Thank you, Anya. Anya's too
Sure.
humble, but one of the reasons why she's here, this is like a buzzword, the bonus depreciation and the big beautiful bill. And I'm very selective who I like to work with. And not only Anya is based here in Houston, but she specializes in commercial real estate and also have quite a few successful case studies for self-storage properties that she's going to be inviting some of her team in the next few webinars to show you exactly how powerful that is. And once you know it, you don't want to be missing the boat.
Mhm.
So tonight we're going to talk about how to grow your money with predictable cash flow and equity without losing access to your money or being at the risk of the income tax liabilities. So this is what you're going to be learning today. Number one, how to cut your tax bill by investing in self-storage. Anya's going to have more details on other properties that she advises and give a very world-class, nice consulting to investors. Number two, how to enjoy the bonus depreciation 100% this year and repeat the process multiple times. And number three, how to do this 100% legally, as I have done with investors in all these 11 years that I've been having fun with real estate investing properties. So now back to you, Anya.
Okay, so I'm going to just start with explaining depreciation in general. Basically, we're going to first talk about residential depreciation, and then the next slide will be commercial. It's about the same. But for residential depreciation, if you have an income property that's not your primary residence, your accountant would take the purchase price of the property. They would remove land value from it. There's a few ways to get land value ratio. One is through the county, one's through an appraisal or a broker's opinion of value. But basically, we need to find a land value ratio / percentage. So we pull that out of the purchase price. And with that basis, that remaining basis, we divide, or your accountant will divide that equally through 27 and a half years. And you'll get a small tax deduction for the life of your ownership of that property. It's a decent deduction, but just know it's just an equal straight deduction as opposed to what a cost segregation study can do. So for the next slide, yeah, let's do next slide. The next slide is commercial, and the main difference between commercial and residential is the year life. So residential is 27 and a half years, commercial real estate is 39 years, except for short-term rentals. Short-term rentals, which are obviously, what you think is residential, falls in the 39-year time frame because the IRS and the government views that as commercial real estate. And it's just something they see as a business. And, I didn't make the rules up, but, that's a strange little caveat that we have. But multifamily properties and condos and single family homes that are long-term rental are all in the residential 27 and a half years, and the commercial is 39 years. So that's your regular straight line standard depreciation. So the example that we have here is you have a commercial building worth $1 million, or the basis is worth $1 million. We've already pulled land out over 39 years. You're going to get a $25.6 thousand tax deduction for the 39 years. If you don't own the property for 39 years, obviously it's for however long you own the property for. And your $25.6 thousand you can delete or deduct against your taxable income. So if you are, however much money you make, $150,000 a year, because you own this commercial real estate, you can, delete $25.6 thousand, 20, let's say about $25,000 a year from your income with your standard depreciation. Okay, next slide.
I'm sure you're very popular. A lot of people are your best friend now after you show them all those tax savings, right?
I
Every
think
year.
and we'll show it next year, but some people think it's too good to be true. So they think it's like a unicorn. And I'm like, this is a income tax strategy we're about to show you, because the IRS incentivizes people who own real estate to save money, because they want you to either buy more real estate or help stimulate the economy in some way, because real estate does make this country go round.
Exactly.
Yeah. So the standard, we go back to, we're still in standard depreciation for self-storage, right? So this is a self-storage example. You buy a $1 million self-storage facility, generates about $60,000 of profit a year. You can now deduct the $25,000 from your taxable income every year for 39 straight years. Sorry, I'm just trying to, it's like the same example as the one before almost. The 42% income tax. So the different holding periods, there's different tax brackets and things like that. We can go over that in a little bit more detail later. But basically the question is how do we get W-2 employees to keep 42% of their paycheck, a year? And the way you do that is through, one way to do that is through a cost segregation study. So bonus depreciation. Okay, so I'm just going to go through this because bonus depreciation is a really fun conversation to be had, and the new bill that just passed has changed the landscape of cost segregation. So cost segregation has been around for quite some time, well before 2017, so 1980s on. In 2017, when the first administration came in, the presidential administration, they put a law in place called bonus depreciation. And what that meant was that you can take whatever savings you get from a cost seg and use 100% of it in your year one taxes. So if we depreciate the property through a cost seg study $150,000, you can take that entire $150,000 to that first year that you do the study. The bill started phasing out and the law started phasing out in 2023. In 2023, changed to 80%. 2024, 60%, in 2025, 40%, and then it was going to just phase out. Well, the new president came in, and in January 19th, 2025, changed the rule to 100% indefinitely. So what that means is if you purchase real estate after January 19th, 2025, you can use 100% of your savings from a cost seg in year one. And currently, that is not phasing out. So it's indefinite. We're not entirely sure when that will change or if it will change. But at this point, if you purchase property in 25, 26, 27, 28, 29, and so on and so forth, you're going to get 100% of your savings year one. Now, at properties that fall into that old law and the 23 property, a property purchased in 2023 or a property purchased in 24, All that means is if you purchase a property in 2023 and you do a cost seg study on it now, because you can, it's called a look back study, you can take 80% of your savings into year one, and then 20% of those savings fall into year two, three, and four. So that's where the bonus changes. You just get to utilize all your savings year one now instead of having to do it through a percentage of different years. I think that's it that I can think of. So I can go to the next slide.
That's the next slide.
Oh, this is bonus depreciation.
Oh,
So, yeah, that's okay.
go
So,
ahead.
same concept. We were talking about a self-storage facility. You could save about on a straight line $25,000, or deduct $25,000 a year. But with bonus depreciation, you purchase a $3 million self-storage facility, you buy a cost segregation study for about $4,500. The fees range, but let's say on average $4,500. And in that study, we determined that you could actually accelerate the property $700,000 in year one instead of the $25,000 in straight line. So now with bonus, that means you can write off $700,000 in year one. And that number is not a blown up number. That is a number that we've seen, that we use on, that we have on a proposal. So you get to deduct $700,000. If you don't or can't use all $700,000 of it, that saving continues to roll over until you use the entire $700,000. So you don't lose it. So just a basic example, you make $200,000 in 2025. Our study offsets $700,000 of that. Okay, well now you start with $500,000 in 2026 that you can cancel out your income for. And I mean, again, if you're going to hold on to this property for at least 3 years, this is really a no-brainer. Time value of money. You want your money now, and the recapture taxes. What we can discuss that if we need to, but recapture taxes, the benefit outweighs that by 10 times because of how much you're going to be able to save in the first couple of years of doing a cost seg. All right. So here we go. The math is done for me. Thank you, Alberto. Standard depreciation, $3 million self-storage facility, technically over 39 years, but that's okay. About $109,000 for that. It's probably about $100,000. But then you do a cost seg, you get bonus depreciation. It's $700,000 for year one. And then, like Alberto mentioned, there's still the straight line available. So your straight line still occurs after you use the bonus year one, and then you'll go back to straight line and still get about $65,000 a year of deductions after that. The next slide. Okay, well, this is a little bit Alberto, but I did want to, just touch on if we want at the end, we can talk about passive, active investors and losses and things like that. But that's the gist of it. We're basically finding assets in your property that don't depreciate the standard 27 and a half years or 39-year life. What we're going to do, the IRS said, is there's things at your property that depreciate actually at 5, 7, and 15 years. And we go in, we find those things, we apply a value to those assets, and we put them in the right bucket of the 5, 7, 15-year bucket. And because of bonus, you can use all that we find in the 5, 7, and 15-year to be able to depreciate year one. So that's it.
Excellent. Thank you so much, Anya. Now you see why Anya is here today. She's here to stay. So stay tuned. The question that you ask yourself, how to leverage that bonus depreciation. Number one, you can buy a property and get another job as an owner operator. Like I told everybody, that you don't see all the hair that I lost over all these years. But it's true. It's here to stay, like Anya was saying. Or number two, you can decide investing with experienced operator, receiving all those tax benefits, like she mentioned, the bond depreciation in year one, and they're so big in some cases you carry over during the holding time for the property without doing any work. So that's amazing. So this is another reason why you're here today. This exactly, and Anya already started working with me from last year. That's how far in advance we start planning for these studies. So We're creating a massive tax deduction this year, and the question is if you'd like to join us. Yes, Rosie?
Hello, it's a very good presentation. Thank you. So I had two questions, Anya. The first one, this one, the cost segregation is also we can use for the house that we are living on, like a owner.
No.
That is the only thing you can't do cost seg on is your primary residence or the house you live in. That's the only property you can't. Any other property, you like a rental or a short-term rental or a lake house, you can, but not your primary.
Okay, thank you.
Sure.
The another one, I don't have now 3 millions to buy something and get us 700,000 of the tax deduction. So see, this is something smaller. For example, I have my W2 job, like I have a salary of 100,000, for example. How I can deduct like 70,000? So how is going to be in the IRS? How is going to defend this?
Yeah, in your case, I'm just gonna say I'm not a financial advisor, so just don't hold any liability over me. But in your case, because you're not a real estate professional, and you don't you can't afford a $3 million self-storage facility, your best scenario would be to buy a property and make it a short-term rental. So buy a house or a condo or a cabin and basically Airbnb it, VRBO it, and then you can cost seg that property. $70,000 is easy to get out of a short-term rental for year one. And you'll be able to offset your active/W2 income because of that, because it's a short-term rental. It can't be a long-term rental. It has to be a short-term rental, but that would be your best scenario for you because of the work situation that you're in, because a good paying W2 job is not a problem. So we don't want you to leave that, but if you do want to be able to offset some income year one or one of the years that you worked in a short-term rentals, your best situation.
Okay, thank you.
Sure.
Good question. So let's continue. Now you're asking yourself, why self-storage? So self-storage is a necessity when life changes. People are moving, downsizing, running a small business. Those needs don't go away no matter what the economy is doing. That's why self-storage tends to be very stable. In downturns of the economy, for me, is finding predictable, steady income rather than chasing trends. So nice to meet you. My name is Alberto. Some of you know me. So I've been doing this since 2014, and now very happy to start the strategic alliance with Anya and her team. So we're going to bring her to any of the future projects that we're working at the moment. So you're asking yourself why this is important for me now. So this has nothing to do with stock market, with traditional rentals, even though you can contact Anya directly if you have any rentals. As she mentioned, some of the traditional residential have to be converted into a short-term rentals so you can have that property converted into commercial and then classify as a cost segregation study. So if you're anything like me, you've been referred to a financial advisor, watch some videos, or deciding what are your financial goals, how you go from here, and which direction. You still don't have a clear path how to get there. So you're asking yourself, if you want to take control of your money, you want a strategy that gives you freedom to you and your family, just stay tuned. We're going to explain you more how that's possible. If you want to protect your family for raising taxes, and we just talk about it, how a very big savings that we can have working with Anya, a simple strategy, this is going to be included on this presentation. If you're tired of looking for safe, proven strategy to reach your financial goals, it's time tested over the last 11 years, this is for you. So the no get rich quick, no courses, just pretty basic rules. And the traditional real estate investing is different to what we're going to talk about today. So just stay tuned so we can tell you more. My story, just to give you a background, came from Venezuela in 1999. And yeah, that's me. I was telling Anya before everybody got in, before losing all the gray hair, working for oil and gas back in the day. So I was doing the American dream, like many that we come for this country for a new life, better future, until I lost almost half of all my savings during the 2008 crisis. And that's why we're here today. That opened the door to see what's possible in real estate investing. And then 2 years later, after that, to make it even more stressful, I was laid off from my oil and gas job. So it was very difficult time. That's when you get proven on your strategy, what you want to go next. I have to reinvest a lot of my personal resources in to keep the properties going. I had no connection or reputations. And at one point, I had to have some file legal lending sharks that it was one of my first deals. And sometimes it happens. And at one point, I had $2.5 million in debt. Some people tell me, well, I have 10, 40, 50,000. Imagine 2.5 million. Of course, it was deep business debt, not the bad, the good debt. But again, it's very stressful when you feel you're back against the wall. So a turning point came. So identify the self-storage as a vehicle, predictable cash flow. I want to talk more about the business model that I've been doing for 11 years. I went all in, no more distractions, and that's why in 18 months I was able to build a very successful portfolio, 500 doors, generating predictable cash flow and upside equity potential. So now we're gonna go into why Anya is here. We actually have two projects in the works and quite a few more that we have to meet again, Anya, later in next month. So this is the business model, how I've been able to generate those predictable results for me and my investors. Number one is the value add, finding good deals. Number two, improving the operations. And number three, growing the NOI, also called net operating income. So my team and I target off-market facilities. This is one of the next coming your way, Anya. Talk more about next few days. So they're usually undermanaged, mom and pop. These are people usually like, my group age in the 50s or 60s. Many times the kids don't want to take over. It's more like a job. They don't have a professional management. They're getting exhausted about picking up the calls, leasing the units. So they don't have a professional, scalable system. And that's usually one of the reasons why they wanted to sell at a good price. And it's a good upside for my investors and I. Number two, we improve operations. Like I said, some of these facilities, they don't answer the call when people are already driving the U-Haul. They need a storage right now. I'm pretty sure you heard that before, Anya. So this is one of the changes that we do. We have call centers, different time zones, taking every single call, and also websites receiving all the inquiries from people that want to search online or the cell phone, or they want to call or email looking for units right now. And then we automate the entry exit is pretty key for security. We had a dynamic pricing, which is, I'm going to talk more in a second, how we do it, and better marketing, which is the big difference. But the most important step of all these three is this one. Growing your net operating income is basically net operating, the difference between the incoming revenue of the property minus the expenses give you that NOI. So if we can increase slightly, filling more units, or like in this property in South Texas, adding more buildings, more units, the NOI goes up. So the NOI grows, the value of the property goes up, and that's the major source of the wealth generation in the self-storage industry. Because number one, you have more cash flow. Number two, you have more equity and a big payday in that cycle of 3 to 5 years. So on the step number one, and again, I'm going to be happy to answer the question. It's just going to take a few more minutes and we'll be done, open for Q&A. Finding the good deals, I prefer direct to seller. Like some of you have seen that case study I did a couple of weeks back. Number two, some metrics in that specific area that tells me that's enough demand existing and growing, square feet per capita, and analyzing the 3 and the 5-mile radius to see what the competition is doing. I want to see economic vacancy. People are charging less than the max potential rental rates. and they have expansion opportunities for open space, more buildings, more parking, as I mentioned in the other slide. Number two, improving operations. That's when I bring the professional management to every single phone call, email is opportunity that most of the mom and pop don't take the time to do it. And it's a service industry. So if nobody answers, consumer or the company looking for storage is going to call the next property or whoever's showing up next on the Google search. And then number three, the most important is how we increase the NOI, combination of the websites that many times are non-functional and people cannot use the cell phones to make reservations or payments. So yeah, that last property I mentioned in South Texas, 2025, the seller had no function website, believe it or not. But it's true, it happens every day with those properties. We add security cameras and some other safety, so people like it a lot. So just to give you an idea, it's a 346 units, mostly non-climate, that some boat and RV and a warehouse and some other parking spots. Now we put in the covered parking so we can double the rent. The acquisition price is 3 million and a quarter. That's the example that Anya just shared with you guys. Just easy math to understand, but this is real. So we're looking to project an equity multiple of 2.3. So each dollar converts to 2.3 at the exit. And these are some of the returns that we offer to our investors. I can go back here if anybody has questions, but this is just to give you the whole picture inside of how the mechanics work. It's usually two classes of investors, the class A looking for cash flow. In this case, we offer 10% annualized. In this example of a 6-year holding time, 50,000 you multiply for 1.6, the equity multiple equals 80,000. 100,000 multiplied for 1.6 gives you 160,000 at the end. And guess what? Anybody who enter at these levels, they have a pro rata participation and the bonus appreciation that Anya was just explaining. And these are people more looking for growth, more risk tolerance, so they can have a more higher participation on the capital, so 2.3 in this case. So these are pictures of the property that now this is where we're doing the covered parking as we speak. And then this is the land for expansion. That's one of the reasons why I invited Anna here, because we're doing some improvements there. And then there's a reason why it's better to have the studies done with Anya, but then do it when it makes sense, especially for the limitations and all the tricks that Anna and her advisory team has for investors like ourselves. So the lessons learned from this is, number one, change doesn't happen overnight. It takes months. We closed this more than 7 months ago to increase the revenue, lowering the cost. Number two, the expansion projections require being careful about budgeting and oversight. In this case, just being in Rio Grande, everybody's very slow. It's a small border town. It took 2 months to get the permits for covered parking on it. Can you believe it? It's crazy. And then in addition to that, we had some bad weather and rainy, so we lost another additional month for that, but it's okay. We're still on the time frame to get it done this year. Number three, professional management is a big difference between okay, good property versus a great one. So these are another factors that help to improve the valuation of the real estate properties, in this case, self-storage. I think I already covered this in the last webinar. We can go back if any questions. This is the most important. We just have another 25 basis point cut in the interest rate. So that actually is good news for us, because when the interest rate goes down, these cheaper debt, and usually the cap rates have a compression, meaning the value of the properties goes up for all those that have a long-term vision in the future. So my goal today is sharing this, not to pitch or sell you anything, just to show you how I work, how my qualified team, in this case, Anya, looking forward to start building strong relationships. The trust comes from being open at what we do. The wins, there's always risk, but the tricky part is how to minimize that risk. And if you walk away from a clear vision why self-storage is such a great opportunity, then I met my goal today. So this is the contact information in case you want to get a hold of me or my team, that you can send a text or scan the QR code. And I'm going to share also anybody who came here the guest speaker today, Anya Smelek, and her email and phone number, and then we can open for questions. Anybody is open, you can unmute yourself or use the chat, and I also have our team just checking the chat in case anybody has any questions.
Hi there, Alberto. This is Veronica. Hello, everyone.
Welcome, Veronica. Glad you made it with a new link.
Oh, yes, thank you. So, this looks like to me an investor will need to come in with a lot of money. Is that so?
This is just an example of the last property we did in combination with Anya and her studies. But in a specific question about bonus appreciation, I'll let Anya answer that question. The answer is you can do it in other type of properties. It doesn't have to be self-storage, but I'm using Anya on this specific property, and some people got that benefit participating on this project in different ranges, 50,000 and 100,000. They also got that benefit, but I'll let Anya answer the other question.
Hey, Veronica. Yeah, I'm not sure if you're asking for Alberto's investments, how much, minimum is. So you could always ask him after I finish. But depending on how much you invest in a property and how much the equity percentage is or ownership percentage is how much you would save off of doing a cost seg. So if the entire, if it's $100,000 savings or tax deduction and you own 33% of the property, then $33,000 you can deduct off your income. But really just depends on how the structure is for the ownership of whatever you invest in. But if you're, I don't know, Alberto, what's the minimum someone can invest with you?
It's a good question. It changes for each property, but thank you for clarifying that, Anya. On average, let's say that on this example that is in $3 million, and the cost savings is actually going to be more, but we just rounded up to make it easy. If you own 10% of that deal, 10% of that case, 700,000, so you save 70,000 year one. And then as we hold the property 6 more years, we have the remaining balance. In this case, this example, I think it was 26,000 and change. So 10% of that will be yours, 2,600. Does that answer your question?
Well, I was asking
here.
I was asking as an investor from an investor's perspective or standpoint, if someone wanted to invest in the storage unit, will they have to come in with X amount of dollars?
Oh, I see. Yeah, this is a case study that just happened March of this year. This is not a new project, but yes. So there's going to be a minimum for participating in future projects. But the good news, like Anya said, you don't need all the capital yourself. Let's say you have to give an example, 20,000 just to participate. So the pro rata percentage that you own with your 20,000, just to give an example, you're still participating on the bonus appreciation year one, which is going to significantly decrease. You still have the money in the bank in your distributions, right? But that's going to decrease your tax liability once we send you the K1 as an investor. And then year 2, 3, and 4, and 5, as we hold this property, you're also going to receive less, but you're still saving taxes every single year that we hold the property.
Okay.
Make sense?
Thank you.
Welcome. Good question. I love it. Hope to see you again next time, Veronica. I'll keep you posted at the next webinar.
Yes, thank you. Thank you.
You're welcome.
So, Alberto, when is going to be the next project?
Good question. We'll see.
I'm ready to go.
Excellent. Yeah, stay tuned. The next project is going to happen very soon. I'm targeting to see if we can make it happen before the next 2 weeks. So stay tuned, and we're going to open the door for a new project, and also happy to join again with Anya and her team to transfer those savings to you guys, because what you have to understand, the reason why some people don't know much about cost segregation, and correct me if I'm wrong, Anya, it's been traditionally on the big dogs kind of deals, right? People that do a $10 million apartment complex, people that do even this, a $5 million self-storage. And now we're opening the door to participate with a lower entry level on the capital, but also the same tax benefit that some of the major players do. And trust me, it's been for me 11 years in the making. This law was not passed until January of this year. So very happy to share with you, Rosie and Veronica, the next project. So yeah, stay tuned. Good news are coming.
Yeah, like Alberto mentioned, most of the cost seg studies cost tens and $15,000, and it just wasn't. The ROI didn't make sense for someone who is just an investor to pay for a study where you're paying so much money for the study itself. But studies have become reasonably priced with some proprietary technology. We've been able to really get the fee down because if you have 50 plus engineers on staff and that's all you're doing is churning out cost segs, we're able to provide it at a much lower fee than a lot of the companies in the past have. But yeah.
I'm surprised, and I actually had a meeting with Anya in Zoom and in person with my CPA. And he's still learning. Many CPAs don't even understand the powerful strategy because even that this is a tax strategy, you need professionals like Anya and the rest of her team with engineering. I mean, I like numbers, but those numbers like, woof, let's
Oh, yeah.
slow it down again because it's very complex. But the good news is available to all of us. And yes, I'll be happy to keep you guys updated as we make progress in future projects so we can share those tax benefits with you guys.
Yeah,
Good question.
I get asked that a lot. I know a lot about cost segregation. I am not an engineer though, and I will not be doing your study. And everyone asks me, "Oh, are you going to do this?" I was like, "No. You want a professional engineer breaking down your property, but I could tell you all about it and how it's going to work." Um,
Yeah, it's
I,
a whole team.
I have another question. So are
Yes.
you guys, particularly you, Alberto, are you guys doing something else other than investing in the self-storage industry? Are you doing like multifamily apartment buildings, things like that?
At the moment, it's only self-storage, but the good news, like Anya said, this bonus depreciation is available to other asset classes. In the future, we might be open to diversify a little. Most likely will be 2026, but at the moment, it's only self-storage. Yeah. I go to bed late every night just working on these projects, and I'll keep you guys posted.
Yeah, and Veronica and anyone on the call, if you want to reach out to myself or Alberto, I can run numbers for you for any type of property, whether you own the property or you're thinking of purchasing the property or whatnot. So we have done a study on every single asset class in all 50 states and in Puerto Rico. So just whatever, if you wanted to reach out, I'd be happy. All our proposals are free of charge. So we run a preliminary, we show you a range of what we think the depreciation is going to be off of the basis that we find. And then you can make a decision on if you want to either purchase that property or run a cost seg study on it.
Okay, thank you.
Sure, absolutely.
Good question. Her information is here. I'd be happy to make the email introduction to both of you.
Yes.
Any other question? I think we did pretty good on timing.
What are your hours, Ayana?
Oh, like my work hours?
Yes.
I mean, eh, theoretically 9 to 5, but I'm in, sales and business development. So I get texts and emails all the time. So I'm happy to get connected past those hours if that works for you. And yeah, just reach out to me and I'd be happy to get something scheduled.
Okay, great. Will do. Thanks.
Thanks, Veronica.
Some of those that I saw you guys having problem connecting, Now's the time if you want to ask any questions, take the advantage of Anya, who's in the house today. And if the audio is not working, just put it in the chat and myself or my team can ask Anya.
Yeah, it could also be, specific to your scenario. You can
Correct.
ask any question and I'll try to help answer that.
The other idea I have, Anya, I don't know if we have time today or do it next time, is the classification, as you mentioned, for being a real estate professional or not, and the active versus the passive that they can
Yeah,
benefit from Cost Seg.
I could, if no one has any questions, I could talk about active, passive, and rep status. So basically, what we call rep status is real estate professional status. And those are people who, it's not a certificate, you don't have to take tests to have rep status, but it's people who work the majority of their time in real estate. So it could be a broker, a developer, a realtor, or anyone that doesn't have a W-2 outside of the real estate realm. What happens with cost segregation studies is you get this benefit. Okay, you get this tax write-off, you get this income decreasing study. And there's two types of income, your passive and your active income. Your active income is what we call the W-2, like everything that you get on a salary. And then your passive income is obviously any type of money you're making off of passive investments. If you are not a real estate professional, you can only use the cost seg benefit to your passive income. Now, there's a few caveats. One being the short-term rental loophole that I had mentioned. If you are hypothetically, you're a dentist, okay, and you get your W-2 or your earnings as being a dentist and you buy a single family home and you make it a short-term rental. Well, that short-term rental can now offset your active and your passive income because of short-term rental loophole. Or on the other hand, you can also offset active income if your business is doing work out of the property you're trying to cost seg. So let's use the dentist example again. You're a dentist, but you have an office. Well, you own that office or you own that property. Now you can cost seg that property and offset your active income as well. So the way to offset active income is by being a real estate professional or having a short-term rental that you're materially participating in or having your business work out of the property that you are cost segging. So that's the passive active rules.
A quick question, Anna, for some of those that have already like a practice business or a full-time job, the real estate professional rule could apply maybe to the spouse. Is that possible?
Yes. Thanks, Alberto. You might as well just do this. You're the professional. I'm kidding. Yes. If you're again dentist rule, you're a dentist. You're not a real estate professional, but your spouse either isn't working or doesn't have a full-time job or W-2, they can qualify for real estate professional status. And because, or if you file jointly, then that real estate professional status falls onto the entire family, not just the one person. We have a lot of clients that do that. They are, attorneys, or I don't know, they work in IT, but they have their spouse get real estate professional status. So real estate professional status is 750 hours a year of any type of real estate work. And that is very easy to get. The 750 hours isn't the problem. It's the 750 hours plus 50% of what you do needs to be in real estate. Again, if you don't have a W-2, that's easy. 50% is easy. 750 hours is easy. The kicker is having a full-time job and trying to prove that you work it more than 50% is in real estate. But yeah, your spouse can also have rep status. And the rep status, again, it's not a test or a study or anything like that. You just keep hours, you log hours to prove that, you're working real estate that year or whatever you've done. And then we don't talk about audits a lot, but in case of an audit, you're able to prove on that spreadsheet, look, I worked 850 hours this year in real estate, and the IRS is like, okay, you have rep status. That's great. Good job.
Great question.
Yes.
Let's see, any other question before we're almost to the hour? Any other question? Going once, going twice, like the auction. Well, thank you so much again, everybody who participated today. I have no words to thank you again, Anya. Now you see why we bring only the best speakers and quality knowledge to every single one of you. The plan is to do this on a more frequently, regular basis. So stay tuned, everybody who registered today. We're going to keep you informed via most likely text and email for the next event upcoming. And Anya graciously share some of the case studies that what's happening right here in our state in Texas and how we can benefit every single one of you. The powerful of abundance appreciation is here to stay, so we should take advantage. So thank you so much, everybody. You have a very wonderful evening. Go ahead.
Thank you, guys.
Thank you.
Thank you so
Thank
much.
Thanks, Alberto.
you.
Thank you.
Bye.